How are you doing today, Jimmy?
Jeremy, I am wonderful. How are you?
Doing great. Doing great here. We are between two fiduciaries. We've got this concept that we're looking at, and really the question that we're asking is it bullish or is it bearish? What signal is it giving off? Okay, so it won't be a big, long discussion, but I think
No.
it's going to be a valid one, a good one here for where we are in the current time and current market situation.
Right. Love it. Let's do it.
Let's do it. All right, what we got here, 20 years worth of money market fund assets.
Mm-hmm.
So you can see it goes up, it goes down, it goes flat a little bit. But guess what? We're $7 trillion sitting, so to speak, on the sidelines.
Right.
And that's a lot of cash.
It sure is. I mean, I think if you start working your way, so if you go to the far left side of the graph here, again, we're going back 20 years, so back to 2005. As we approach the financial crisis, the money, you can see the balance increasing, which makes sense because the stock market was performing so poorly. People were, scared of the market, pulling out, a lot of people pulled their money out of the market completely, right, and just sat in cash.
Right.
Now, some of them got back in, some got back in much later on, and some maybe have never gotten back in. But nonetheless, that sort of increase you see on the far left side of the chart, that makes sense. And then we got a flat line for a while, right? Which also I think makes sense because in response to the Great Recession, we had interest rates pegged at zero, right? The Federal Reserve pegs interest rates at zero, which is an effort to stimulate the economy and the stock market together. And so we stayed flat for quite some time. And then
we all remember it, 20 years where
Yeah.
you have to put money into a money market at your bank, let's say.
Yeah.
And you were making less than 1%.
Right. So you weren't even keeping up with inflation.
Not even
And then
close.
whatever interest you were earning was getting taxed. So net of taxes, you were definitely losing money to inflation. So, then look, as we continue on the chart and we see the rise, you had COVID and all this pandemic spending that went on, which created some inflation. And the Federal Reserve's response to that was to raise interest rates starting in 2022. And we had these huge spikes in interest rates. So it makes sense that you would have seen a bunch of money move to cash because now the yields in cash were really attractive, right? We were seeing north of 5%, on 3 month, 6 month, 9 month, 12-month treasuries that are in theory risk-free.
Yep.
And you were getting north of 5%. So those yields were very attractive. Now at this point, as we stand here today, the 10-year treasury is hovering right around 4%, slightly below that. So your shorter term bonds and the money market funds that are tied to those are yielding less than 4% at this point. So $7 trillion of cash, twice the pre-pandemic level. That's a lot of cash that's sitting out there.
So with the Fed on a cutting trend right now,
Right.
it's likely that we're going to see we've perhaps seen the peak already.
Perhaps.
Right?
Yeah.
But it's sort of tied into so many different other market variables as well. And so that's the question we're asking here. What signal is this giving you?
Right.
Is it bearish or is it bullish? Or is it maybe somewhere in between?
Right.
Maybe it's none of the above.
Right.
So here are a couple of arguments that you would make if you were saying this is a bearish sign.
Right.
So much money on the sidelines, right?
Yep.
Okay. Investors are seeking safety.
Of course. And like we just mentioned, the safety that you were getting in 2023, the yield you were getting is much better than you are getting now. But it makes sense that we still have a good chunk of cash sitting there. The hardest thing to do is to get back in, right? Getting out is one part of that equation, but getting back in is difficult for many. So it's not that surprising that we have this much cash on the sideline, but double pre-pandemic levels is quite a bit.
It is. Okay. The other one is, look, there's people, sure, they like the 4% that they're getting.
Yep.
But they feel like jumping into the market right now is just a bad move. It's
All-time highs.
overvalued. It keeps getting higher. The price to earnings ratio is higher and higher.
Right.
The AI trade.
Yeah.
You name it.
Yeah. It's hard, right?
It's hard to for some people to get off the sidelines.
Right.
Right. But that's also maybe a little bit of a bad reaction.
Yeah, well,
Maybe.
I mean, who knows where you're really at in this cycle, but I understand the psyche of it being difficult to get in when you're at all-time highs. But just because we're at all-time highs doesn't mean that you can't continue to go higher.
Right. The momentum of the stock market in particular is a very powerful force.
Very.
And so if you miss all the up just because you're waiting for the down, you might just miss a lot of the upside of the market. Our thesis on it is pretty simple. You ride the waves, but you're going to ride a market that's up 80% of the time.
And it's also built on a plan, right? This always comes. I mean, we always joke
Yeah.
about the importance of building a plan. It's not a joke, but we talk about it so often it becomes comical for us.
It does.
But this is where, to your point, like riding the waves. If you've built a plan that allows you to have the comfort that you can navigate and withstand the market ups and downs, then it makes it much more comfortable for you to do so and not have these panicking emotional reactions where you're all in or all out.
Another one here, the last one is, what if a lot of this money starts flooding into the stock market? Isn't that another huge bubble that we're creating?
Right.
Right. And
could be.
And I'd say yes, that's a possibility, right? Bubbles have certainly been a factor in the way our stock market has played out in the last 20 years.
For sure.
So, okay. Now, here's the bullish side. All right. Remember, folks, it's the bull with the horns goes up. That's the idea. The bear with the paws goes down.
Right.
So that's why we say bullish. A wall of cash is sitting out there. It's ready for investing.
Yeah.
Right?
I mean, you got $7 trillion out there, right? And the rates are going down, so you're being disincentivized to keep the money in cash. If we do expect if the Federal Reserve does continue to cut rates, you're going to continue to earn less and less yield on the money market funds there. Well, the money's got to go somewhere.
Yeah.
Right. If the yield there is no longer attractive, where's it going to go?
Right. And cash is king, right? There's always that saying out there, and there's nothing wrong with having some money in cash, right? It's just,
sure.
Maybe a lot of people have money in cash. Maybe it's a lot of institutional money. It's hard to dissect exactly what the flows are inside of these huge amounts of money.
Right.
But at the end of the day, we're not saying there's anything wrong with cash, and having cash doesn't mean that it's some sort of problematic sign.
Right.
It's just diversification at the end of the day. Maybe a higher amount than normal, perhaps.
Absolutely.
But also we have to remember we were in a pretty eased environment here prior to right after COVID, like you were talking about. Okay. Yeah. Now the big one here, I think, is there's a reallocation, typically from cash to stocks, that creates this rotation that is uplifting to the market. So the argument might be this: look, if we have a natural 10% pullback in the marketplace, it's probably going to be fairly short-lived because you've got all this money sitting on the sideline that's ready to deploy.
Right.
And it's probably going to take the market back up at some level.
Right. No, I think that's a great point. And the long-term saying of don't fight the Fed. Mm-hmm. If we are in an easing cycle that is going to continue, it's usually a good signal for investors to be taking some of that cash and put it into the stock market.
Right.
When they're raising rates and becoming more restrictive in their policy, well, that might be time to, bundle up some more of that cash for you. But right now, it seems like we're more likely to be headed towards additional easing.
It certainly does. So that's it. The case is out there. There's the jury's in, right? But guess what? It's a hung jury.
Yeah.
It could be bullish, it could be bearish, right? It depends on your overall disposition, in my opinion.
No question.
I think that it's part of the natural order of things as much as it is anything else. It's probably not a huge signal.
Agreed.
That's all we have today.
I enjoyed it. Thank you.